And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we are kicking off a 6-part series. I've really been looking forward to this one on decoding mortgage programs, right? We're going to take the next 6 weeks and each week dedicate to a certain specific type of mortgage and use for it, whether by buyer or type of property, and break it down for you. This week's episode, part 1 of this 6-part series, we're focusing on mortgages for first-time home buyers. But before we get to that, Joe, this coming weekend, it's amazing how fast time has flown by. We are already this weekend at Memorial Weekend.
Yep. The schools are already starting to finish. My son's about to be a senior. It's ridiculous how quick this year is already going by.
Well, I know you had mentioned to me, I got to show this off. I'm going to tell on you in front of everyone if I can figure out how to share my screen with this. You do something. Is this every year that you do this, Joe?
This is the first year that we've done this. You remember we had Dave on last week, Salisbury, and his wife, Kathy, is part of Keep Argyle Beautiful, which is our town. And she calls me on Monday and she says, hey, you know how we put the flags out every year? And I was like, yes. She goes, well, this is my first time doing it. And I was like, awesome. She's like, I need help. So Monday I'm scrambling, trying to figure out how I'm going to get people to help us put out American flags down Highway 377.
Okay.
I reach out to my son and he's like, yep. Why don't you reach out to Coach and see what he can put together? So I reached out to Ben Rudolph, Coach Rudolph. He's the O-line coach and assistant athletic director, I believe, at Argyle. And great guy. And he helped organize us to have these volunteer guys show up. So everybody showed up at 6:00 this morning. High school boys, 6:00 in the morning. We met at the town hall in Argyle. I don't know if you can share the pictures. And we went out, and here you can see a couple of the boys. So each street going down 377 for probably about 4 miles. We put out anywhere from 6 to 10 flags, 12 flags at one intersection throughout the whole thing. And, it's awesome because it's just celebrating this weekend. There's so many memories. Memorial Weekend, thank you to anybody that is served. But we had 13 high school boys from freshmen to, they're about to be sophomores in 2 days to about to be seniors. And Coach Rudolph right there in the middle, he was out there with them helping. I was out there. But Kathy Salisbury put it together in the city of Argyle, had all the flags, and we had to put holes in the ground and then push these flags down in and kind of stabilize them. But we had 13 high school boys show up at 6:00 this morning. So I really want to give a shout out to Ben Rudolph. Thank you so much, sir, for helping organize this, and to Kathy Salisbury for organizing this. You can see the whole group there. And then one of the city workers back there with the hammer and the thing in the background. We asked him to jump in, and he was all about it. But most of them are O-line. We have a freshman quarterback that is in there too. He showed up. And then one of the guys, he's just a friend of the guys. And one of the guys was like, I'll be at your house at 5:45. Well, they were banging on his window at 5:30 this morning to get him out of bed. He even came and helped. So it was a great group of kids. My son was there. It was a great time, just kind of, doing something special to, for this weekend, for memories, for celebrating, the United States and celebrating our military. Joe, you and I were talking, you asked me if I had any family that was military.
Yeah,
my mother-in-law was Navy, and then my grandfather was Army. What about your family?
Yeah, so I come from a military family. My dad was a lieutenant colonel. He was 32 years in the military and flew backseat of the F4, so he was the Rio in the backseat. After retirement, he worked as a civilian for the military as the deputy base commander at an air base up in Michigan. So he was second in charge of the base. My brother, right above me, he served in the Air Force. My uncle, my grandfather. So I come from,
Oh, a whole family military.
yeah, absolutely.
Well, that's awesome. Well, thank you to them for all they've done in the service, and all military. We appreciate you guys, and a lot of the things that we're going to talk about over this next 6 weeks. The series that we're doing. Is a great benefit of loans for especially our military, active duty, reserves if you've gotten through your time, and then veterans, of course. But thank you for asking about that. Thank you for sharing that. And again, out to all the boys that showed up, really appreciate it. And the city's actually going to buy them pizza, I think, today in City Field House. So it was awesome to have 15 to 18-year-old boys showing up.
Well, I think it's fantastic that not only did you do something for the military families, Grand Memorial Day was actually a long time ago referred to as Decoration Day, but it came, from back in the 1800s, actually, with Civil War in America. But it was really to commemorate those that not just served in the military, but died in the line of duty, right? So any of you military families out there that have a loved one that gave the ultimate sacrifice, from the bottom of our hearts, we truly appreciate everything that you and your family has done and served for the freedom that we have. And Joe, I think it was fantastic what you did this morning, because not only did you do something to commemorate that, but you also passed it on to a younger generation and teaching them the standards and principles of this. So thank you for what you did this morning. That's fantastic. It really is.
I have to say, there's so much out there today about teachers and about pushing agendas that are different than the core values of the United States. And I have to really give a shout out to Argyle. They do a great job on keeping, Christianity in the schools. You don't hear of that all the time anymore. And then they also the history of America, the good and the bad.
Yeah,
there's a lot of bad that came about it, but we wouldn't be where we're at without some of that and the learning lessons that we've had. But I really appreciate our town for their teachings and all the parents, because I know all the parents of those boys, and every one of them is a stand-up person. And as you can tell with that coming out today.
Yeah.
So, well, I know we're going to get into the rest of it, but real quick, if you are listening or if you have questions, even if the show's not live, please put it in the comments. Joe and I look at these. We show them on air. We want you guys to ask questions about this, because we're talking about loans, how to get mortgages, right? The decoding. I like how you put that out there. Decoding mortgages.
Yes.
Today I'm really excited for the first part that we're going to talk about. There's going to be a lot of back and forth, but for anybody buying a house, these are the episodes you want to watch. And today, being first time home buyers, is what we're really going after.
Yeah, I agree, and especially I love kicking this off with first time home buyers, because really this is the market that is really the best market for first time home buyers, right? Because 2-3 years ago, when people were looking at buying a home, I mean, those were the folks that already have a home, right? And they're selling it and they're putting offers in, able to put offers in 20, 30, 40, 50,000 over list price. First time home buyers can't do that, right? They're not in the position to do that.
Well, and it was ridiculous. I mean, everybody wants the low interest rate, but you couldn't get a house if you were looking in, the 250s to 350 range, because they were gobbled up by everybody else that were investors.
So quick. Yeah. Yep. But here's the thing, though, that I want to start out with in regards to first time home buyers, because amazingly, there's still a large percentage of people out there that think that the down payment for a home needs to be 20%. Folks, I'm going to tell you right now, Joe and I will tell you straight up, this is, we want to debunk this, just bust the balloon open on this one, because you don't need 20% down. there are different programs for first-time home buyers that you need as little as 3%. Now and matter of fact, let's break this down into the basics as far as 3 basic types of mortgages: a conventional, an FHA, and a VA. Now, a conventional,
you got to put USDA in there too.
we might as well, right?
Just because depending on the area, but for first time home buyers,
rural areas, that you can use it. Yep. So conventional loans, 3%. That's the minimum down payment for a first time home buyer. 3%. So you're talking a $300,000 home. That's $9,000, right, for your down payment. Now, granted, there's closing costs. We can get into that in a different episode, which I think, by the way, Joe, I think that'd be a great episode to cover, right?
I think we're going to cover some of that through how we talk about, down payment assistance or ways. I mean, we're going to get into that here today, but I think doing closing cost and going through it would be smart, because not everybody understands what's a common closing cost and what are add-ons. So I think that you're right.
Because not only I know for you, Joe, we get first-time home buyers that think that they just need to come up with the down payment. Well, there's more to it than that. So we'll have to cover that in more in depth. Conventional, though, 3% down payment. FHA, 3.5% for the down payment. Now, VA and USDA both have options for zero down, right? So you don't need that 20% down. I think that 20% down that, our parents and stuff tried to drill in us was from way back in like the 80s, when PMI, and that was the reason, PMI, they didn't want to pay PMI, private mortgage insurance, right? So if you put 20% down, your loan to value of the home was at 80%. And that's when you don't have to pay PMI. Now, PMI back then was super expensive compared to today. Today, PMI is cheap, quite honestly. I mean, what was it, Joe? A year and a half ago, the FHA dropped their rate on PMI?
Yeah, it was, I want to say 22 is when they dropped.
So maybe 2 years, year and a half.
0.85 factor to a 0.55.
Mm-hmm.
And that brings up a great point. What are the differences between those 4 loans that you just talked about? It's not just the down payment; it's also the qualifying. How do we get qualified? But let's talk about conventional first.
Okay.
The 3% down, because there's a couple of ways of doing a 3% down, especially first-time home buyers. As long as one party that is going to occupy the property is a first-time home buyer, you can qualify for 3% down, no matter what your income is.
Correct.
So, the nice thing about that is 3%, 9,000, you're going to have a higher payment. You might have higher mortgage insurance on that, but you can get into a house and stop renting.
Right.
The other nice thing about 3% down is if you're 100% of your area median income, and you can actually look that up. If you Google Fannie Mae income limits, it'll bring up this website. You can click on it and you can put in your zip code and see where is your income in relations to the area median income, right? With the area median income, it can actually, if you're at 100%, the nice thing about that is those loan level price adjusters, which this is another thing that, Joe, we probably need to have a show on, is it's the risk factors that they put on to get your interest rate and what the interest rate cost, for anybody that's watching the show. So if you're at that 100%, you don't have any loan level price adjusters for first-time home buyers. That is only for first-time home buyers too. So that's one thing that people don't always understand. And so you can get a little bit better on your pricing if you're at that 100%. Well, if you're at 80%, you get even better mortgage insurance premium. So that helps your payments even more on those conventional 3% downs. So, a good loan originator like yourself, Joe, and I, we make sure that we look at all these different options and what's best. Joe, I want to know your answer to this. When you're looking at the difference between going conventional 3% or FHA 3.5%, what is one factor that you look at on that application that kind of makes you talk to a client? Now, I know we present options, but what is one thing that makes you, as a professional, kind of tell them why an FHA or a conventional is a better product for them?
Well, you bring up a good point, because between conventional and FHA, what I typically do, and I know all of you and I both do this, Joe, is that for first-time home buyers, when we put their application together, we bring all the information in as far as their income, credit score, their debts. I mean, all these different factors, because folks, it's not just your credit score that's going to determine everything. There's a lot of factors that go into this. So what I do is I look at both conventional and FHA, and I do a side-by-side comparison. Okay. Because depending upon their credit score, their PMI may be higher on conventional. And lately, FHA interest rates have been lower than conventional. So matter of fact, do you remember the loan that you helped me with up in Michigan a couple of weeks ago?
Yes.
Right. So
when you had
when I had my surgery, when I had to step out for a quick surgery, yes.
Right.
So with that, what happened when I was coaching the client through that, I was showing them different options, conventional and FHA. Actually, conventional came in $200 a month, well, $193 a month higher than the FHA, right? Because of how they qualified. The PMI was cost more for the conventional than the FHA did. And the FHA, with all the different lenders that you and I work with, which is like over 20 lenders, 25, 26 lenders.
Yeah.
We're able to shop that around, and the FHA rate came in lower, almost a whole interest rate lower than the conventional. So in that situation, the FHA was the right way to go, right? Now, conventional, though, does have some good loans, but it's all about qualifying, right? And how you qualify for things. So, like a conventional, let's cover some simple stats, right? As far as guidelines stats, we'll keep it very simple and generic. We won't go too in depth for you guys, because if you're a first-time home owner or wanting to be, I'll just keep it simple. We won't go too in depth and confuse things. So let's talk conventional first, right? Conventional, 3% down, minimum. Credit score, minimum credit score to qualify, 620, right? And then you're going to, like Joe had said, with the AMI, the average median income, if you're 80% or lower, and we'll help you in figuring that out, no worries, we'll help you. If it is, you're going to get a better rate and reduced mortgage insurance, right? As far as the PMI goes.
So Joe, you brought up 80%. So I actually looked up Montgomery, where you're at. To qualify for Home Ready Home Possible is $76,160.
Yep.
And then I know Denton County, where I live, it's like 85,000.
Okay.
So
it depends on where you live.
Yeah,
right? It can be different.
It's different throughout everywhere. I know down in Victoria, it's a little bit lower. Houston proper or the Woodlands area is probably a little bit higher than what you are in Montgomery.
And I would imagine California, it's even higher, right?
Oh, yeah. I don't even look at California because I don't want to know. But people moving from California to Texas, we have to look at where you're, and it's based on where you're moving to. That's the big difference people don't understand is if you're moving from California to Texas, or you're moving from Texas to California, you might fit into those categories based on where you're moving to. So that's one thing that we look at. I like conventional loans, but I do more FHA and VAs than I do conventional. And the reason for it is for first-time home buyers, you're typically staying in this mortgage on average, even when rates were lower. I think the average is going to be jumped up, because people are now financing off of those 3s and 2s and stuff like that anytime soon. But your typical was 3 to 5 years. Now I'm betting it's probably 5 to 7 years.
Yep.
But your first-time home buyers are still going to be in that 3 to 5 years.
Mm-hmm.
And, you know, Joe, when you bought your first house, you might be different than I, but how long did you live in that first house?
10 years.
Okay. So you're way outside that average.
Yep.
First house, I moved in a year. My second house, 2
Wow.
years. My third house was 4 years.
Okay.
So what people need to realize when you're buying your first home, don't think of that as your forever home. That is big difference in today's society than when, you know, our parents bought homes.
Mm-hmm. Mm-hmm.
And, you know, that's a big way of looking at it is if you can get into a house that maybe it's not what you really want. It's not that big, extravagant. This is my show off home. I want everybody to know who I am. You're not going to get that on your first time home buyer.
Yeah.
Sorry. You're coming out of college. You got your first job. You're not making, you know, $500,000 a year. And if you are, great job, and show me what you did different than I did.
Right.
So, well, you know, so the FHA loan in those cases makes a lot of sense to me because
you're right.
You, like you said, we can get a little bit better interest rate.
Yeah.
And if your credit score, I will tell you, I understand you said 620 was the minimum credit score to qualify conventional. If you have a 620 credit score and you're putting less than 20% down, no loan originators ever tell you need to go conventional.
Yeah. Even though you qualify.
Yep. Your mortgage insurance. And that's the difference. That's one thing that we do need to talk about is the difference between mortgage insurance on an FHA and private mortgage insurance on conventional.
Yes.
On FHA, it is not based on your credit. It is a strict
standard
0.55 factor standard for anybody and everybody that goes FHA.
Mm-hmm.
Where on conventional, we have to take into credit risk,
loan to value,
DTI,
mm-hmm.
and loan to value, different policies, right?
Yep.
So, you know, if you're a 620 putting 3% down, I'm talking to you to doing 3.5 and going with FHA every
Absolutely.
time.
And here's another factor, and just quickly give guidelines for FHA, right? So, talking 3.5% down payment, 580 for credit score. Right?
Joe, we're gonna have a blooper for you.
Oh no.
Yeah, you just locked up, and your frozen face looks good on this one.
Are you serious?
Eyes shut, head back. Looks like you're sleeping, and I'm only talking. And you sound like a robot right now. Oh, I swear, us in technology is awesome. So
this is not good.
Okay, I can hear you, but yeah, your picture's still frozen.
Oh no, this is ridiculous. Choose.
Oh man, he sounds like a robot. It always happens. Where I think Joe was going with this until he comes back live with me is we were talking about FHA and people putting down. Now you can go down to a 580 credit score on FHA, but debt to income ratio is the biggest part of this. Yes. And want people to understand, as mortgage people, we don't want to put you into being house poor. Hey Joe, you're back.
Am I back?
You're back.
Am I? Yes. Yes. Did you cover for me?
Yes, I did.
Okay.
But what I was saying is on FHA, 580 is the minimum credit score. The debt to income ratio, you can go over 50%. And the reason this is
really wanted to hit
is not for us to put you in a payment that you can't afford.
Right.
But sometimes you have a significant other, a spouse, a partner, whatever you want to call that person that is buying that house with you. Maybe they can't qualify. Maybe they don't have good enough credit. Well, we can do a loan going FHA. We have to take their debts into account if you're married. Now,
in the state of Texas, by the way.
Right.
Okay.
In the state of Texas, if you're married or any community property state.
There you go.
FHA, I want to say it's any state technically, but community property for sure.
Just community property.
Okay. So we have to take the debts into account for that significant other. Now,
Mhm.
one of the kind of loopholes is it's marriage.
Mhm.
So if you're common law, technically you're not, in lending purposes, let me make sure I phrase this correctly.
Yep.
You're not married in lending purposes.
Right.
Because we don't ask the question, are you common law? We ask, are you married?
Married. Yes.
So if you are, and we have to, and you can't, either there's not income or we can't put them on, then you can go that route, and we could go a little higher on that debt to income ratio. And
To qualify.
any
Yep.
loan originator that is just maxing out the income or the debt to income ratio, they're doing you a disservice unless they know that you have. Like I had a client that had a side photography business,
Mhm. Mhm.
made money, but it wasn't provable income. He puts on taxes and stuff like that, but it was a secondary employment. We went FHA because it was breaking even, but I knew there was more income there. His wife and him both had regular jobs too.
Mhm.
So I was able to get them more purchase power, knowing that they had this other income coming in that we could not source. So FHA was the right route for them for the house.
Absolutely. Yep. Now, I know we don't have much time left, and there's definitely more stuff that we need to jump through real quickly here to help people out in decoding these mortgages. VA, I definitely want to touch on VA real quickly here.
Yes.
So for VA, as we said, I love working with VA loans. 0% down, no PMI, right? But here's the thing though, is that in regards to credit score, a lot of people don't know this. The VA does not set a minimum credit score. They don't. There is no minimum credit score. The only ones that set the minimum credit score are the lenders. Now, most lenders, they put it at what, Joe? 620?
No, on VA, I've got them down at 550 usually.
So,
I've seen that.
well, I know you and I, we've got a couple lenders that'll go down into the low 500s, even certain exceptions with that and everything, right? But I mean, you don't need a 700 credit score, folks, for this VA, right?
Now,
I mean, the
do.
VA is
I'm going to
really.
touch on one thing though, there, Joe.
Go ahead.
Is can they have late payments in the last 12 months on any of their debts if they have a low credit score?
You're quizzing me, aren't you?
Yes, I am.
Is that it? I think they can have, is it one or is it two that they can have? One? Zero.
So one thing that you first-time home buyers, it's important that you keep your credit up, okay? But credit scores, FICO scores, can be affected by medical debts that are charged off for collections. Right. It could be affected by credit cards being at the higher max, limit. You have a higher balance on them. Those things we can overcome with lower credit scores on VA. But if you just did not pay your bills, you didn't go out and you have a lot of charge-offs, you have repos, things like that. I don't want to give false hope that you don't have to have a credit score to get it. You still have to show that you're responsible enough on your credit to be able to get it, even if you have a lower score.
Absolutely. So, you do. Yep.
It never fails. We always think we have 30 minutes to fill and it's going to take forever. Let's go to topic.
To get rid of our coffee talk in the morning,
No, we can't. That's my fun time.
I love our coffee talk, but so before we go, because we're basically at the 30-minute mark, I was
going to say the topic 3. We've got to talk about that.
We do. It's in regards to down payment, right? Because how, especially in today's economy, how are people able to save up the money for the down payment? Closing it, just down payment alone, even is tough. Like I said before at the beginning, if it's a $300,000 home and you're doing 3.5%, I mean, you're looking at 9, 10, 11,000, 10,500 if it's 3.5, right? I mean, that's a lot of money in today's economy to try to save up. So what are some ways to be able to combat that or help out with that? So one of them is called, go ahead.
Well, let's make sure we mention this, because this is a great reasoning why we're talking about this topic. And I know we're going to go over time and we're just going to deal with that. And maybe we take our podcast to 45 minutes on some episodes, and this is an important one. So when it comes to down payment, we keep talking about 3%, 3.5%, 0%.
Right.
There are closing costs. There are
Mhm.
escrow setups. There's a full year of homeowners insurance that you have to pay. That's all included in the funds for closing. So as we're talking about topic 3, we're going to talk about how we can get around and get, different types of down payments, but also the one first part of this topic that you're about to bring up is the seller concessions.
Yes.
That is what we use to knock out your closing cost.
Yes.
And so Joe, kind of go from there. I just want to make sure our viewers understood there are other things than just the down payment that you have to be accounting for.
Yes, absolutely. And seller concessions can definitely help out with that, right? Now, seller concessions can go to a lot of your closing costs and that, not towards your down payment, because the lender still wants you to put skin in the game, okay? So these seller concessions can definitely help out in all those closing costs and everything, right? Which can add up. I mean, depending upon your property taxes and where you are, I mean, you could be looking initially in setting up the escrow account for it, you could initially be looking at a good $5,000-$6,000 just in that. Who knows, right? We can help you figure that out, though. No worries. But with seller concessions, essentially what you're doing, let's say I'm going to buy a home from Joe, right? And it's $300,000 is the list price. I know I keep using $300,000, but it's an easy number. So, and my math isn't, well, I need help. So anyways, so let's say that I'm using a conventional loan. Well, with conventional loan, you can have up to, because they put a cap on this, up to 3% in seller concessions that the seller, Joe, is going to give me in buying his house. Now, I may end up with 3% of, okay, so that's $9,000. So I may offer Joe in my offer to purchase his home, I may give him an offer of $309,000, but asking for 3% back to me to be able to use to help cover my closing costs. Now, FHA, very convenient. FHA, believe it or not, that can go up to 6% that you can ask for in seller concessions, right? You may not need all 6%. You may only need 4 or 5%, right? But your realtor, and folks, I'm telling you right now, and realtors, I know that you're shouting right now, but everyone, I'm telling you, as a buyer, you need a realtor in negotiating these things, okay? This is not something that is a matter of simple document you can do.
It's not just putting information on a contract and signing it.
Yeah, you need a realtor doing this for you. I'm telling you right now. Now, VA, I always want to throw VA, your maximum seller concessions is 4% that you can get, right? 4%. Hopefully that kind of explains a little bit of seller consent.
That's how, for everybody listening, that's how we get most of your out-of-pocket taken away, so that way you can utilize a couple other things for a down payment.
Yes.
So now, gift funds.
Yes.
Who can gift? So any family member, can
immediate
gift.
Family member.
Immediate family member. They kind of, FHA put in there, it can't be cousins anymore because I think everybody just said we're cousins. But parents, of course, aunts, uncles, they put fiancés in there now. In-laws, those they can gift. So any type of family member, immediate family member can gift funds. And gift funds, what they have to do, real quick, is on conventional, we can have the money sent directly to title. The only thing we have to do is have a gift letter signed by the buyers and by the gifter.
The gifter.
And it has to be actual gift. And you can't be, hey, I'm taking a loan. Can't do that. To have your down payment. Gift of equity. So if you're buying from a family member, they can gift equity for the down payment. And loan originators, I just helped somebody yesterday how to set one up because they are different than what most people think. If somebody's wanting to buy a $300,000 home, but they want to only sell it to you for $200,000, Well, you don't just do a 200,000 purchase price, because now you've wasted the gift of equity and, you know, your closing costs and things like that. So we need to make sure it sets it up.
Yes.
401k loan or hardship withdrawal from 401k. People don't understand that. So if you can't take a loan out, but you can do a hardship withdrawal to buy a primary, you don't have to pay the penalty percentage.
Tax penalty.
You have to pay taxes on it.
Well,
you have to pay taxes on it. Yeah,
right.
But you don't have the early withdrawal penalty.
So
that's
great
nice
feature.
Yeah.
Definitely.
And I know we're going to do an episode on the last part of this.
Next one.
We'll get into that.
Yeah, we're going to leave everybody a cliffhanger on this. So the
I'm going to let you leave the cliffhanger.
The other way that we can help out with your down payment, closing costs, and that is using what we call DPAs, or down payment assistant programs. Right now, next week, that's what we're going to be covering. So if you're a first-time home buyer, tune in next week. Again, you're going to want to hear this information. Cup of Joe Mortgage here. He is like the Yoda, right, of down payment assistance programs. So he's going to be taking the lead. I'll still be here tomorrow just to kind of, or next week to just kind of say hi and everything. But he's going to take the lead on this because he's such a master at down payment assistance programs. There's a lot of them out there, and you need to know how to navigate them, right, and the features of them and everything. So next week, we're going to be covering that and going on with part 2 of our 6-part series on decoding mortgage programs, covering the in-depth the down payment assistance programs. So tune in next week, usual time, right? Wednesday mornings, 9 a.m. Central Standard. Got to thank everyone for tuning in. We didn't have any comments today. I think it is, we didn't have a special guest. Usually when we have a special guest,
we're worth listening to when it's just the two of us. People can tune in and just hear our voices.
Well, we think we are, but
we will have a special guest during this series, guys. But today was mainly Joe and I, and next week, I love how you call me the Yoda. I've kind of had to put myself in that situation because I have to teach the other loan officers how to put them together.
Yeah.
So down payment assistance is something that's near and dear to me, especially if it's something that you need. Now, if you don't need it, I'm going to tell you don't go with it. But down payment assistance is a great program.
Absolutely. So tune in next week. Hey, if you want to catch up on some of our other episodes that you missed to learn even more, go to our YouTube channel, The Mojo Show Real Estate Podcast. And while you're there, hit the subscribe button because we are on a mission to get to 1,000 subscribers by the end of the year. And I know with your help, we can do that. Before I close out, Joe, any last words?
I just appreciate anybody that listened, or if you have questions and you weren't able to watch us live, please put them in there because Joe and I do check our Facebook. We do check YouTube. We want to be able to answer any of these questions that you might have.
Absolutely. All right, folks, I'm Joe Mortgage, and that handsome guy there is with the beard on his Cup of Joe Mortgage, and we'll see you next week.
Mr.